I'm Ben Waverly, and today I'll be talking about microloans and how they affect social justice and the economy. Let's begin by briefly defining microloans. Microloans are very small, short-term loans given at low interest, especially to people to start up a company or self-employed people. They can sometimes be up to $50,000, but the average microloan is about $13,000. Microloans are involved with social justice because of the positive effects that they can have on both individual people and the economies of African countries. In these impoverished African countries, microloans can start at as little as $185, for every little bit helps. The idea is that the individual people that receive microloans in these countries will be able to take that money and start their own businesses with them, providing many other people with jobs, not just themselves. For example, even a loan of something as small as a sewing machine would be able to help somebody start a clothing business in Africa. And the first person that actually received the microloan would easily be able to pay it back after starting that business. However, not all microloans are given out to African countries. Many people in the United States have also turned to microloans for their small businesses. In fact, there's even a U.S. Small Business Administration, or SBA, that facilitates all third-party loans made in the country and sets baselines for who can receive them, who can lend them out, and interest rates. The program also provides many assistance programs for small businesses, including key financing needs like debt financing, surety bonds, and equity financing. However, Africa is definitely where microloans are needed the most, and there have been many successful microloans that have turned into successful businesses in Africa. One great example is a woman in Africa that used her first microloan to start buying and selling cooking oil in her local community for a profit after joining a microloan group in 2010. She was eventually able to open a small tea room to provide a stable income for her family and provide her children with a good education so that they could follow their dreams of becoming doctors. However, not everyone in Africa actually knows how to manage their money as well as we do, and not all businesses that get started up because of microloans actually end up succeeding. Therefore, many people in Africa that receive microloans aren't able to actually pay them back with the interest. Because of these failures, people have been forced to sell off their assets, such as their houses, or borrow money from their family and friends in order to pay back their microloans, leaving them in a worse situation than they started in. In reality, the majority of the people that attempt to take out a microloan don't actually profit from it. Many of them lose more than they gain. In that sense, although microloans seem like a great tool to decrease poverty, it has actually caused more poverty than it has prevented in some areas. So, how can we work together to ensure that these microloans are actually effective and not worsening the situations in Africa? Well, in a way, we can, because after all, this is a lending system, not free money, and the lenders do expect to get their money back 100% of the time. Starting a business with loans is always very risky, and there will always be downside. So as long as microfinancing is a lending system, there's really no way to ensure that all microloans will always be beneficial. However, there are definitely ways in which we can responsibly limit the amount of risk the people that take microloans out will have when trying to start new businesses. One great example of a very successful microfinancing organization is the Grameen Bank. Led by Muhammad Yunus, the bank is a Nobel Peace Prize winning foundation that has changed countless lives in Africa by providing microfunding to many individuals without requiring collateral, which is another asset that the borrower offers as a way for a lender to secure the loan. Founder Muhammad Yunus reasons that if more banks for the poor are made, like the Grameen Bank, with similar goals, then the millions of small people with their millions of small pursuits can add up to create the biggest development wonders. That's a great goal for all microfinancing groups, but when someone wants to borrow, how can these groups tell that that person will actually responsibly pay the loan back? Before actually lending to somebody, a microfinancing group would want to measure the credit risk of lending that person a certain amount of money. There are both formal and informal ways of measuring credit risk. A very common formal way of measuring credit here in the United States is through a company called FICO. They give you a credit score based on your payment history, employment, and many other factors. However, many of the African countries that have people applying for microloans don't actually have the infrastructure to measure credit risk in a formal way using programs like FICO. An organization called Opportunities International, a Chicago-based organization, had a different idea to measure credit risk in African countries in a less formal way. This organization, instead of looking at the financial backgrounds of African people that wanted to take out a loan, instead looked at the church that they belonged to and asked the priest about this person. This gave the microfinancing groups a better way to discover the characteristics and the personality of the person that they wanted to give a loan to, and help them decide whether they would lend the money out or not. Although a long-term goal should be to provide the infrastructure in Africa to use more formal methods of measuring credit risk, using more informal methods like this one is a great temporary alternative to measure credit risk. However, measuring credit risk is not the only issue when it comes to microfinancing. Gender equality is another concern. If we look back at the Grameen Bank, one of the most successful microfinancing organizations in the world, 97% of all their loans go to women. This is not because the Grameen Bank or any other microfinancing organization is only lending to women. It is simply because women are often working as single parents and need to support their families, which are sometimes very large in Africa. Therefore, they are in much more need of microloans than men most of the time. In conclusion, although we cannot ensure that all microloans are effective all of the time, we can responsibly work to decrease the risk by using more informal methods of measuring credit risk. This will ensure that microfinancing organizations will be lending money out to responsible people that will do everything in their power to pay the loan back.